Annual point-to-point IUL has incredible historical rates of return. In this episode, I'm going to address the question how to make money safely in a volatile stock market. Get ready. What I'm going to share with you, many financial professionals do not understand, nor have they been taught, and that's very unfortunate, and I don't want you to be left in the dust. So my name's Doug Andrew, and I've helped many thousands of people optimize their financial assets now for more than 47 years and minimize taxes, empower what I call their authentic wealth so that they can enjoy a comfortable retirement and from a financial standpoint, never outlive their money if they live to be 120. Now, my favorite vehicle to achieve that goal is what I call indexed universal life insurance contracts. And I want to share with you at the beginning of this episode, okay? My favorite vehicle I call the Laser Fund. Okay, Laser is an acronym. LASER stands for Liquid Assets Safely Earning Returns. It's a vehicle that uses the chassis of an indexed universal life. So, the Laser Fund is an indexed universal life. Having said that, not all indexed universal life, in fact, most indexed universal life policies would not qualify to be classified as or deemed as a Laser Fund. Okay? A Laser Fund is an IUL structured properly, funded correctly, and designed to optimize your rate of return and your living benefits more than just the death benefit, to where people have actually earned average rates of return between 7 to 10%, but sometimes returns of 61%, 158%, and in these episodes, you can learn about different ways to use indexing. So when we say indexed universal life, that is where you're putting your money into an insurance policy and you're taking the least amount of insurance that the IRS will let you get away with under some tax citations called TEFRA and DEFRA. They were passed clear back in the 1980s. You're taking the least amount of insurance the IRS will let you get away with so that it doesn't turn into a taxable investment. You want to stay under a tax-free section of the code. And these sections of the Internal Revenue Code have been around in one form or another for over a century. Technically speaking, they're sections 72E, 7702, and 101A. So in order to accumulate your money tax-free, and then be able to access your money, have tax-free income, let's say starting at age 60, 65. We have people retiring at age 35, and they take out $5,000, $10,000 a month, sometimes $50,000, $100,000, $200,000, $400,000 a year, and they don't have to put it on their tax return. The IRS knows they're receiving it, but it's not taxable, so there's nowhere on a tax return to put it. They know it's tax-free, it's that cut and dried, because it's been grandfathered as a sacred tax-free cash cow in the Internal Revenue Code for over a century. When you put your money in the insurance company, you can just let them pay you the interest they're earning on their general account portfolio. This is where they invest your money in AAA, AA bonds, and sometimes mortgages on skyscrapers and shopping malls, but they do it so conservatively. Insurance companies have weathered the Great Depression with flying colors when some real estate dropped 80% in the Great Depression. Banks closed their doors. 40% never reopened them again. Not one single legal reserve insurance company went under in the Great Depression. Same thing in 2008. 400 banks went under. 900 more were on the brink or the watch list to go under. Guess how many legal reserve insurance companies went under in 2008 in this country? We came so close to a financial collapse, if you didn't know. Not one insurance company, zero. In fact, when the federal government asked the 5 major banks in America to disclose where they had their Tier 1 assets, that's money they have to have on hand, liquid and safe in case of a run on the bank, a recession, people panic. Guess where the banks have 30 to 40% of their Tier 1 assets for liquidity and safety? In insurance companies. Because most insurance companies are rated like 6 notches higher, triple A, double A. A lot of banks are only rated triple B. That's 6 notches higher in safety. And by the way, the banks are borrowing our money. When we put it into the bank, they pay us what, 1%. They're sort of borrowing our money. They pay us 1%. They turn around and put it in insurance companies and have been earning 4 or 5%. Every million, they pay $10,000 to us, but they make $50,000 and increase the safety. The point is you can bypass the middleman and go directly into the insurance company. So let's get back to what universal life allows you to do. You can just settle for the general account portfolio rate, which is low right now. We're in a 40-year interest rate low. That would be around, let's say, 4%. But anytime you feel bullish about America, you can link your returns on that universal life to an index or indices of your choice. What does that mean? Now, before I go any further, I want you to click like or comment, share this with others that would be interested in this. But look at this channel because I have several educational videos on indexing. I'm going to simplify it here and talk about the 1 year point to point. In a nutshell, if you accumulated, let's say, $1 million in your insurance policy, we have many people who accumulate $500,000, $1 million, $10 million. Let's just use $1 million. Let's say you're age 60 and you have $1 million accumulated in your insurance contract. A properly structured indexed universal life, it gets cheaper as you get older. Did you hear that? And so you have $1 million in there and your objective is living benefits. If you feel bullish about America, they do not take your $1 million and invest it in the market. It has to stay safe in the insurance company, earning, in this example, let's say 4%. But anytime you want, you can say, you can take that 4% interest on my $1 million and do whatever you want with it to have the wherewithal to pay me whatever the market grows by. So if they offer the S&P index, they link your returns. Your $1 million doesn't go in the S&P. They take the interest, 4%, 40,000, and they buy upside options. If the market goes up 10, they pay you 10. If it goes up 15, maybe they cap you out at 12 or whatever. And so they pay you because those options will double or triple. But what happens if the economy tanks and drops 40% like in 2008? The options expire worthless, but you didn't lose your $1 million. Your $1 million is still safe in the insurance company. This is called indexing. So the most common strategy, there's several that you can search on this channel. The most common is called the annual point to point. That is where anytime you feel bullish about America, you could say link. So any money you've put in or the money that's already in the policy, usually companies will link on a date like the 15th of the month. So if you put in money on the 10th, it'll sit there and earn the 4%, for a few days. And then on the 15th, they link it to the S&P. Let's say it's November. November 15th, you wait 1 year until November 15th of the next year. And then you measure, did the S&P, if that's the index you chose, is the S&P up? Let's say the S&P was 1,000 when you said link, and a year later, it's 1,100. This is actually sort of what happened in 2011, 2012. Okay, that was an election year, Obama's second term, by the way, and I knew the economy was going to be artificially high. So I said link. So if it went from 1,000 to 1,100, that's a 10% increase. On $1 million, they must pay you 100,000 of interest. Where did they get the money to do that? Because back then, the general account portfolio, whether it was 4% or 5%, it was 5% back then, those options doubled to 100,000. People say, well, how can the insurance company afford to do that? They're big boys and girls. They're the #1 purchasers of options in the world. They do this hourly. They wouldn't do it if they couldn't afford it. They're not having to cough up the money. The options are doubling and tripling, so they can pay you 10 or 15% or up to a cap, or maybe there's no cap. I'll explain those in other episodes. But a 1 year point to point is very common, and that's where you measure from that linking date, the 15th of the month. Now, sometimes people do dollar cost averaging, and so they take 1/12 of their $1 million and say link November to November. Another 1/12 of their money links from December to December, and then January to January, February to February, March to March. And so you have 12 linking dates, and that sort of smooths it out. That's called dollar cost averaging. The point is you wait 1 year, and then they will credit you whatever it did. Generally, there's a cap. They might cap you at 10.5 or 12%, but that means if the market went up 15 or 20 and the cap was 12.5, you only earn 12.5 or 10.5. But what's the big advantage? If the market crashes, like 2008, none of our clients lost one dime in 2008 due to that market crash. They may not have made anything. The options expired worthless, but they didn't lose. People who had money in the market, their $1 million went down to 600,000. Our clients still had their $1 million. They simply gave up the 4% on the million that year to sort of go for it if that's what they were doing. Does that make sense? That's called an annual point to point. So let's use one of the worst 10, 12-year examples to illustrate the power of indexing annual point to point. Let's go from November of 1999, just before the turn of the century, to 2012. This is the worst 12-year period since the Great Depression. Okay, if you had your money in the market, let's say you had $1 million in the year 2000, because of 9/11, the terrorist attacks, people who had their money in the market saw that million go down to about 600,000 in 3 years by the end of 2003. It took 4 years until 2007 to make back what they lost, to come back to break even. Do you know people who used indexing? Many of them, their million had doubled to 2 million in that 7 years. Some of them, it grew to $1.5 million, but they didn't lose. They may not have made anything in 2001, 2, and 3, but they didn't lose. And as soon as the market turned around, they started making money on top of their million because they never lost any of their million. Is this making sense? What happened in 2008? As Warren Buffett put it, he said, when the tide went out, it revealed who was swimming naked. Those people who didn't protect themselves lost 40% again for the second time in a decade. Went down to 600,000. It took 4 years until 2012 to make back what they lost. Many of our clients doubled their money even again. Conservatively speaking, people who used indexed universal life in the year 2000 to 2010 averaged 7.23%. That is a 10-year period where there were 5 loss years compared to 5 up years. Most decades, there's 7 up years compared to 3 down years. 5 years you would have earned 0, but you didn't lose. 0 was your hero. The other 5 years you would have made money, and only 2 of those years would you have capped out if there was a cap. And people averaged 7.23%. Do you know the rule of 72? $1 million would have doubled to 2 million, tax-free, when most Americans barely were getting their million back. But because we went till 2012 to compare apples to apples, when people in the market finally came back to the million, many people using indexing, their million had grown to 2.5 and even 3 million. You can do this. It's important. This is the way to be able to seize annual point-to-point indexing to make sure that you don't have to be exposed to the volatility. Your money can be safe when the market is topsy-turvy going up and down. During retirement, you do not want to rely on the market to continue to go up, because when it goes down, people panic and they have to tighten their belt and they go, I can't afford to pull any money out of my IRAs or 401ks right now because the market's down. Why do you want that stress? So folks, if this is intriguing you, subscribe to this channel. I have so many other episodes that talk about the power of indexing and different ways to use indexing, whether it's 1 year, annual point-to-point, cap, no cap, participation rates, and on and on. But if you like to study and learn and see charts and graphs, claim your free copy of this book. It's book number 11. It's been flying off of our warehouse shelves. Several hundred a week go out. It talks about the laser fund, which is an IUL, but not all IULs would qualify to be a laser fund. You have to structure it correctly, fund it properly. This is how to diversify and create the foundation for a tax-free retirement. You contribute a nominal amount towards the shipping and handling. I cover the rest of that. There's options in there to listen and learn, watch and learn. This is 300 pages, charts, graphs, explanations. You even flip it over and there's 62 actual stories of clients that have used this not only for retirement, but all kinds of financial goals. It's like a financial Swiss Army knife. You ought to explore this for you.